All right, everyone. Once you have your daily flow and process, we need to know when to enter trades, how to manage them, when to get out, different things like that. So when you trade the understanding of the market and different deliveries, you're going to be able to create rules for yourself around how you enter the market based off of how you feel, what your risk tolerance is, different things like that. But I'm going to give you a basic overview and the models that I trade and the way that I manage and things like that as well. So everything that I've taught up into getting an entry is a model. It is the model. It's how the market moves. We choose what type of what pieces of it we want to trade, and it's all based off of when it gets to your key level in the order of delivery. We need to confirm the direction. So when we have an overall direction in the market, whether it being down or up, we want to look for trades in that direction. But if they get invalidated, we can take trades in opposite directions as well. So, one of the most common trades that we'll talk about is either coming off of the EQ or trading below or above the overnight session or the order submission range, and to see if we're going to create a market structure shift to come back up inside the range. So, when we're trading inside of here, first trade for this buy is we want to see what happens when we close below our ranges. Below our ranges is the liquidity that gives us our opposing liquidity run. That's what we want to be looking for. So we look for engineered liquidity inside of our ranges that we can possibly get an OLR or the start of our stop hunt piece of the order of delivery. Because once you have that, you understand if we're going to continue going down or up at any point in time. So the ranges give us liquidity instead of having a blank chart and having to look all over the place and try and guess where the liquidity is. The ranges give you that liquidity. So once we close below it here, we want to see what is printing. So the most important piece, or one of them, inside of the order of delivery is the stop hunt because that gives us our direction. Three candle swing low, low of the range. We print a gap. What I want to see when we print a gap is for that gap to be closed in. Because at that point, it confirms the order of delivery and the direction. As we're trading the understanding through this, before you take a trade, you always want to have a draw on liquidity. We want to have an idea of if this gets closed in before any of this prints, where can the market possibly go? So we've got a few different targets in here that we can look at. We always want to get out inside of liquidity. So these failure swings tell me that we're most likely going to push up there if we can close this in. And then we've got equal highs formed as well. So since the market runs for liquidity, these are areas that I can see us going to, along with this volume imbalance. And these are places we know how to trade. So I don't need to be a hero and say that overall is bearish, but if we're coming back inside here, we're going to have to take this high and we're going to have to go up here because the market is showing me that we're bearish or we're consolidating. So once this gap gets closed in, now I want to see how we're trading at the equilibrium. So closed in, now we have a confirmation of direction. After a confirmation of direction, now I know what I want to see here. As this is trading back down, I can get into the market anywhere around this candle or around the equilibrium. As soon as this trades back up and we don't close inside of here, that's giving me more information that's saying we're respecting this bullish key level because closing above here makes this a bullish gap and the equilibrium becomes a bullish key level. So entering after this snaps back and you have confirmation is permitted. We don't want to enter as this is closing because remember, the market needs to come now back down to fair value for us to take our trade. So see if we can still see maybe not. Let me back up to the daily. It's all right. I guess I erased it. In order to take the trade, we need confirmation of direction, and then we need to get back to fair value because the markets are not buying as it's going up and not selling as it's going down. They're buying as it's going down here into a key level, and then they're selling as it's coming up into a key level. So we want to do as close to that as we possibly can. And that becomes clear once the direction is confirmed. So trading this CSD here is permitted, but the directional confirmation on this time frame hasn't happened yet. So we rejected the 50% here. So before this closes, this can be a rejection because this is a bearish key level to then continue going down. But once we close that in and we're trading back inside of ONS and our order range, this gives me confirmation of direction to now take the trade. Other ways to target or to trade above 50% of the expansion because we want high level targets. We want the highest probability targets that this is going to go to. So I can add a lot more positions here. I can get out at 50% here, or I can get out as it's trading above the failure swings and then make a lot of money because I know there's a 98% chance it's going to go here, but then like a 30% chance it's going to go here. So I want to be getting out at the highest probability targets. It doesn't matter how long you hold. It doesn't make you a better trader. What makes you a good trader is keeping this process mechanical and making money consistently. I can make money consistently trading to right here to here, no problem. From trading right here to 50% of this expansion. Those are all high probability targets. Even if this is going to continue going up here, I know that if we're failing to close above a gap and we're continuing bearish order flow, that selling in a premium end of this zone to get back down to 50% or to our previous targets is permitted. But if I get out here, that's perfectly fine. As you can see, when we're moving up and down, that's 122 points. And that's a simple target that the algorithm is going to seek for almost every single time. So we don't need to be holding for crazy amounts of trades. Depending on what time frame you're on, is going to give you the duration of the trade. So on a 5-minute chart, the trades are going to be a little bit longer than necessarily on the 1 minute or sub 1 minute. But the targets are going to be the exact same. So entering and then entering after we're confirmed here, you can take it here, or you can wait for another down candle's high to get closed above if you want, because that's continuing bullish order flow. Once this candle closes, we still want to wait till we get down to below 50% of this candle. This is leaving a failure swing. So this is what the markets makers are going to buy. We look for these liquidity points as targets, and we can look for them as entry points because we buy sell stops, and then we use it to run for buy side. As long as the order of delivery is showing you that we're confirmed bullish, we know that we're targeting these, and then we're looking at these for entries. We're not necessarily looking at these for sells because we've confirmed the market to be bullish or short-term bullish for this trade, which is why I say getting married to a higher time frame bias as a day trader, you don't necessarily need it. But when it does expand in a higher time frame direction, your best trades are going to be taken in that direction. But when we're consolidating like this, since we know how to read key levels and we need know how to frame fair value, then trading this up, trading this down, trading this up, trading this down, it makes sense. This is confirmed when we fail to close above it, and then we take this low. So trading and selling this, completely permitted. Then we need to see how we're trading here. We had lower target, which is going to be this low. So selling here to take out the lows in bearish markets is permitted. Now, if we do go on smaller charts, after we have our 5-minute key levels here, then we can trade accordingly as well. So here you can see we never came back into. So as we're accumulating and trading lower, since we never confirmed anything on the 5-minute yet, you don't need to get lost in trying to buy in here. This is an accumulation, clearly. We need to wait for a stop hunt or what's happening in the next piece of delivery. And so if you're looking at the 1 minute only, after we have this market structure shift, because we are closing above the origin, we're closing above this gap, CSD, and we're creating a gap. This tells me on the 1 minute that we are short-term bullish, but we still need to close above this 5-minute gap. So even though it doesn't come back in here, on the 5-minute, this is a permitted trade. On the 1 minute, you may be waiting for it to come back down here, which is perfectly fine as well. As long as we're following the 5-minute targets here, we won't get lost in the 1 minute. So this is all the 5-minute failure swings. This is where we're expecting it to go. The equal highs here. So as we're moving up into our targets, if we're following the 1 minute, we want to make sure we're still expanding above highs, expanding above highs, expanding above highs. This is a nice little retracement, but we're still not coming back into here and invalidating the bullish bias or short-term bias to get us into where we want to go. So these are where you can layer in to trades, but you want to wait, get used to taking the original entries first. So as far as entering, again, make sure you're looking for fair value after your direction is confirmed. That's the most important part. Direction confirmed, fair value to sell above this failure swing, above 50% of the CSD, and then you can sell inside of here. There's no reason to wait for a crazy amount of CSDs once you have a confirmed direction. So all you need to realize there is that I'm buying this because this is coming back to fair value. This is coming back to fair value of this expansion. Anywhere inside of there are great entries because we're still expanding to the upside. Expanding to the downside, sell up here. Expanding to the downside, selling anywhere up here. I would sell this candle because we came above 50%. And then we took out the failure swing. Where your stop needs to go. We're not RR traders. When you are an RR trader, that it forces you to have a set stop. So if you say, I want a 30-point stop with a 50-point target, and that's what I'm going to trade every single time. That means if you enter here, and it comes back down on you, because this is all permitted areas for the trade to come to, you're going to get stopped out. because you've got a set stop loss. So if you're chasing a trade and you enter here, you've got a set stop loss that could possibly come and get you. Taking the trades anywhere around here. It doesn't matter where you take the trade, your stop loss is set, but your stop loss may be in an area where it's acceptable to be taken. So what you want to do is when you enter, you have to understand where the trade can get invalidated and where it can come to. So 50% of this order block, even down here, can possibly get wicked. So if you are taking the trade, it's a large stop. On the 1 minute, we can refine our stops a little bit more, which is where I tend to take the trades. But the point is, you have to understand where trades can get invalidated and where these wicks can constantly go. So when you're taking the short position here, your stop can go above here. It's safe as long as that high took liquidity. So you never want to put your stop where there's a failure swing because it can get run. This candle took liquidity from this candle, so there's no stops above here. So my stop should be safe. We shouldn't need to go back up there right now until we come back into a discounted area and accumulate more longs if we're going up. So my targets are the same as my entry points. I want to target where the market can possibly turn around. So targeting this gap that was closed in, that could possibly give me more bullish trades. I want to be out here. I don't need to hold for down here. I can hold part of a position to possibly get down here, but this is the highest probability target because this is where the market can turn around. As I'm taking this trade and it's going up, taking profits at places where we can turn around. It's not set. I just waiting for us to take liquidity, and as the market is taking its profits, I'm taking my profits as well. So if this trade comes down here and I want to buy this candle, my stop needs to go below this candle's low because this took liquidity from that candle. But if I'm buying this candle, my stop can't go below this candle's low right here because this is a failure swing. This is what the market buys. So if my stop is here and my RR says I need to keep my stop loss here, otherwise I'll lose too much, it's liable to get run. But if my stop's below here, I'm safe. Maybe a larger stop, which is why we work on precision entries. But our stop is safe here because it's going to go for the liquidity. But once it hits that liquidity and I enter here, I'm not worried about it going back down here until we get to our target. So as you can see live as it's moving, we're having adverse reactions here. So this is where I'm out of the trade and where I'm taking most of my profits. Because if we're buying, this is a key level. And if we're continuing bullish order flow, we're either going to move back and forth or continue taking the high. Once we start closing above highs, we can look at our structural targets. And then if we have our key levels or our algorithmic timed key levels on the chart, those are targets as well. So everything is read as a key level. We read the key levels all the same. As long as we wait for confirmation of direction and fair value, then we will be safe in the trades and we'll be going over the stuff constantly. So this is just a basic overview of it. But the entries and the models are all based off of reading key levels and fair value. So the reason I don't trade one set model is because I trade the understanding of what the market's doing, which allows you to get into any trades that you want as long as you have your rules around it as far as confirmation of direction and fair value. Those are the main points to entering in the market. So for a fail-safe entries, you can use I like this one, the DeLorean EMA, using the 3, the 7, and the 200. These are the settings for it, these three. Before you get used to entering as things are going down or as things are going up, you can look at the EMAs, but you're going to use them with your confirmations. So as this EMA closes, as we close above the EMA cross in an area that we're looking for if we're going to buy or sell for our confirmation, as this confirms here, as it comes back into these EMAs, you can take buys. So all the EMAs do is they give you more of a confidence boost as you're learning this stuff. Once you understand the direction and all that, you won't use EMAs ever, really. But this coming off of these directions, we close back below the EMA, failing to close back above it, you can take sell entries there. So you can use this as a guide while you're navigating through fair value. And then as far as overall movement, the 200 were below. So that tells me that bearish movement is a possibility. After we close below this, the overall is bearish. So using your overall direction, lining that up with these 3 EMA times can give you a little bit of an added confidence boost. Like I said, as this is moving, you can see we are rejecting off of the low of overnight session. So sometimes that can add to a trade, but being what time it is now, I would already be done for the day. So go through your overnight session, go through the 5 minute, go through the 1 minute, go through whatever time frames you want. See where you could enter in the market based off of confirmation of direction. So we want the gap to be printed and we want the directional gap to tell us where we're going to go. So anytime we have that or a key level, the order block, closing above an order block, those are all framing what we're going to be doing. These are all key levels. If we can't close above it, then we have to wait. After we have confirmation, we can sell around those levels as well. They all play out the same. So thank you for watching this one, and we will see you on the next one.